I want to bring a simplified management chief strategist, Mike Green. Mike, it's so amazing. So Boomer's getting blamed for a lot of things. It was a fantastic piece. I'm going to tell everyone to go to your Substack and read it. I'm going to use the Claude version because I was able to make better tarts with this. Let's talk about this. Breaking it down first, the mechanical wealth machine.
Yeah, what we've built in our system in the United States is withholdings from paychecks go directly into the stock market and index allocations. That is driving up the value of assets. It means that the incremental earnings that are coming from the younger generation are buying less. Those who came before in classic Ponzi fashion already own the assets. They're benefiting from the price appreciation.
And so the price weight spiral, the fiscal implications, what are the fiscal implications from all of this?
Well, the single biggest fiscal implication of the way we've structured our retirement system in the United States is that you have tremendous uncertainty as a retiree. I have huge sympathy for boomers who are unfortunately forced to hoard assets because they don't know about that end-of-life uncertainty. That ultimately means they underspend relative to the assets they have. That spending is the income that's supposed to flow to the younger generations, and it's simply not happening at the pace we need it to.
And your point is it's been an extraordinarily positive feedback loop for the stock market, although not the stock market. Yesterday was an amazing session, right? Yeah. Because you only had 100 names that were higher. It was like the worst good day in history, right? So you've got the names we all know: Apple, Amazon, Google, Tesla, obviously, NVIDIA. Those names, NVIDIA way over here, by itself yesterday and today. So what does this mean, though, for the stock market? Because a session like yesterday really was deceiving in the sense that the market really was not up. So many stocks were down.
Yeah, this actually goes directly to the chart you shared earlier on the equal weight versus the market cap weighted components. When you think about allocations into a passive index, it's going to send that money in proportion. So you send $1,000 to an index fund, that money is allocated on the basis of the weights. If NVIDIA is 8% of the index, it's going to get $80 out of your $1,000. The smallest company in the S&P is currently CarMax. That's going to get something like a penny out of that $1,000. Right. That $80 powers NVIDIA higher. The next day, another $1,000 comes in, and $81 goes into NVIDIA, and it powers NVIDIA even higher and higher. That's the price weight spiral that unfortunately is built into index methodology, and that's what we've blessed as our retirement system. So we're unthinkingly sending our money into what we think is the safe space, but we're really driving the phenomenon that we're seeing.
Beyond generational fairness, you say there's some other issues here. You just alluded to the artificial valuations, the Ponzi structure of this eliminates price discovery, good old-fashioned price discovery, and younger workers are disadvantaged. Whenever someone uses the word Ponzi, it's a red flag. Does it suggest at some point it's a house of cards and it all comes down?
Unfortunately, it does. It means that much of the wealth that we've actually created in our retirement system that's indexed to the equity market capitalization is largely a mirage. When you try to take that money out of a Ponzi system is where you ultimately discover that those valuations were not actually there, that the assets that you thought you owned, that you were saving for your retirement, are not really there to meet your obligations. Unfortunately, that has implications, as you might expect.
Yeah, well, that's what happened to Madoff, right? When the market was getting hammered, he kept sending out statements, I'm up, I'm up. They're like, what? We got a place to go for money. And we found out it wasn't there. So the cruelest irony, I love when he wrote about this, it's not a conspiracy, it's worse. It's a system where everyone following prudent advice is actually, being forced into this thing. And so does the Fed, how does the Fed tie into this? I guess the question is, we've got Fed day to day. They're going to make it more accommodative. Wall Street likes that generally. And it feels like this keeps going until, of course, it doesn't.
Well, I definitely think that, unfortunately, it keeps going until it doesn't, right? That's somewhat of a truism in its underlying construction. The Fed's role is very, very different than we usually think of it as. When the Fed cuts rates, it's going to affect the incomes of those boomers. They're going to spend even less. That'll be a negative impulse into the economy. The lowering of interest rates, when we're talking about 25 basis points. So you're saying the boomers,
they benefited. The idea was restrictive policy would slow down the economy, but we saw trillions going to money markets, and we saw them spend, right? 10% spending 50% of the cash. This actually might reverse that?
This actually starts the process of reversing that. If you think about those $7.5 trillion in money market fund assets, earning excess returns that are being created by the higher interest rates that we never really expected a couple of years ago, that sustains spending in a huge way. About 70% of that interest income gets spent into the economy, creating a multiplier effect around it. That's much greater impact, actually, than the spending effect from higher wealth.
Wow. That's ironic. Your stuff is so good. I hope everyone watching goes and reads it. Thanks a lot, Mike. Appreciate it.